Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh, and a very good afternoon. While the global conventional banking system gradually recovers from one of its worst ever financial crises, the Islamic banking sector, in retrospect, as one of the research report puts it, remains an oasis of relative calm and prosperity during this period. Why? Well, a common refrain explained by many practitioners and commentators in the Islamic banking field is that Sharia law precludes Islamic institutions from getting involved in complex trading with no assets, and as such, was spared the vagaries of risk related to financial transactions unpacked to real economy. To rattle off some of the catalog of risk inherent in Islamic banking would serve no purpose, as I'm sure all of you at some point would have heard this in other conferences or read up in some literature elsewhere. What we want to focus on today is the actual, real, on-the-ground risk faced by the Islamic financial industry currently. These risks are deemed relevant and current based on the current economic condition, as well as the recent governance relating to it. More importantly, we will also need to look at the credible solutions to these predicaments. Joining me to explore and discuss further on these topics, we have an august selection of Islamic finance practitioners and subject matter experts. On my furthest right is Kenneth, Aboud, Managing Director of Allen and Overy. He heads the international capital market practice in Singapore. Kenneth has extensive experience in Islamic finance and capital markets and has been named one of Singapore's leading capital market lawyers in the Asia-Pacific Legal 500. On my immediate right is Shahrizal Sulaiman, Executive Director of PricewaterhouseCoopers. He has over 12 years' experience in the finance industry, specializing in Islamic finance. He has been involved in Sukuk advisory, Sharia governance, Sharia audit for Islamic banks. He is also an active speaker on Sharia risk in Islamic finance. On my furthest left is Rushdi Siddiqui. He is the co-founder and managing director of Azka Capital, who also needs very little introduction. He is known and recognized globally for his achievement and work in Islamic finance, halal food, and OIC countries, amongst others. He led a team to establish the world's first super index as well as the first Islamic ETF. On my left is Professor Dr. Engku Rabiah. She is a prominent Sharia scholar currently with the International Islamic University Malaysia Institute of Islamic Banking and Finance. She has published numerous articles in journals and periodicals, both locally and internationally. She also serves as a member of the Sharia Advisory Council of Bank Negara Malaysia, as well as the Securities Commission. She is also currently an independent Sharia advisor for Islamic security issuance registered with the Securities Commission of Malaysia. With that introduction, let's begin our discourse. Perhaps I could start off with some views from Rushdi Siddiqui, who I understand that he wants to give an overall view of the risk first, and then I will go into some questions and answers which we will discuss in the panel itself. Yes, please.
Assalamu alaikum. Good afternoon. It's a pleasure and honor to be here. This is actually my 10th KLIFF, so I was there from the very first, and it's been a remarkable achievement for the entity itself, and a lot of kudos for a lot of hard work for a lot of people. I wanted all to know that this is actually a franchise that's built a brand over the years. So what I wanted to do was talk about risks. We know in Islamic finance, it's not risk transference, but risk sharing. But in risk sharing, you can't eliminate risk, so you mitigate risk. My colleagues will talk about risks associated with products, process, divisions, Sharia compliance, and the entity. And these are important. I wanted to basically go a little bit higher, sort of a jet engine view of risk at 35,000 feet, and they'll bring it down to ground level. And look at risks from the point of view of reputation, because reputation risk actually rises to a systemic risk in the industry. If you don't address this, then you're not going to have this sustained growth in Islamic finance, and these Muslim countries who do not have Islamic finance will basically not have Islamic finance. So at the first level, there's the political risk. What I mean by that is the depoliticalization of Islamic finance and the anti-Sharia movement. When Egypt was led by someone from the Muslim Brotherhood, they said Islamic finance has arrived. He exited as the leader of Egypt. Does that mean Islamic finance has also exited? So there has to be a delinking from the political process of Islamic finance. In the West, there are many bad perceptions concerning Islamic finance, and frankly speaking, the industry has failed to talk about what Islamic finance is. It's a business with rules of engagement. It has less to do with religion, more to do with profit sharing and not profiteering. So at one level, there's this political risk. The second is financial inclusion. This is probably the biggest Achilles heel for Islamic finance. Of the 1.8 billion Muslims in this world, maybe 2 to 3% have exposure or have become a participant for Islamic finance. The flip side is, the upside is huge, but what is the industry doing? We had a speaker from Kazana, the chairman, vice chairman, speak about microfinance, speak about SME finance. We're talking about the non-bankable, the underbanked, which is basically in most of the Muslim countries. What is Islamic finance doing for the financial inclusion? Business model. It's a risk. We know that they're going after the marginal customers. We've seen our cabinet, an Islamic investment bank, come out of bankruptcy in the U.S. We've seen Gulf Finance House change their business model. We've seen the investment bar incur some challenges. We've seen Islamic Bank of Britain and FSA Group go through 2 restructurings. This presents certain risks with respect to the business of Islamic finance. This is a business risk, nothing to do with the Islamic teachings, and there has to be a bifurcation of that. I don't want to get into the awards, but the key issue there is transparency. CSR of Islamic finance, zakat and sadaqah, is basically not CSR. CSR is Islamic banks, because they are involved in financing a lot of real estate projects, infrastructure projects. Not one Islamic bank, to my knowledge, is signatory to the carbon principles, the climate principles, or the equator principles. Right? I don't know how many Islamic banks have linked up with NGOs. So if you're going to talk about Islamic finance at the highest level, which is the political, but there's no linkages with NGOs or no signatory to the climate principles, what is it that you are talking about? With respect to risk averseness, Islamic finance is collateral-based finance, right? We are Rabiah-centric. That actually has not touched the man on the street. When are we going to expand towards the man on the street and their particular needs? In other countries, we talk about support. No one has talked about an agricultural support. Right? So, from my point of view, Islamic crowdfunding and agriculture support customizes to the local needs of the people. The final point is delinking and demystifying. We started the process of delinking from conventional with benchmark indexes, and that's great because it goes to authenticity, indigenous development, and addresses the question of what's the difference to the man on the street. But we need to continue moving forward from negative screening to positive screening on the Islamic equity side. We need to address finally, first and foremost, that Islamic finance is not for Muslims, so it's a rebranding issue. Now, if I were to sort of link this together from a political point of view. You have to send a message to where these arrows are ending up. From a business point of view, or financial inclusion, these are the areas that need to be cross-linked. And only from a business model point of view, you see what arrows are linking to. So the net of this is at 35,000 feet level, there is a systemic risk because there's a reputation risk. We need to address this before we also talk about the issues concerning products, the issues concerning investment account holders, depositors, about capital charges. So I just wanted to lay the foundation for the basis of the remainder of the conversation. Thank you. Sulaiman.
Thank you, Rushdi. That was actually a good coverage of the risk inherent in Islamic finance. If I could go into something a little bit more specific for the purpose of this discussion today, and like I said, something a little bit more, something more current and issues which the Islamic banking industry are facing at the moment. I have a question here which later anyone of the panelists could respond to it. In Malaysia, currently, Mudarabah has been used as a concept of Islamic current and savings account product since the beginning of Islamic banking. Recently, however, there has been a move to apply a pure Mudarabah concept on these deposit accounts, therefore rendering this to be no longer a deposit fund but an investment-based fund instead. Now, where the bank is prepared to take in Mudarabah deposits, in reality, are the banks prepared to not allow the customers to get the returns that they are normally used to, or even in such circumstances, allow the customers to absorb the losses in the event the bank is not making any returns? This is a question which the banks actually do face in reality. Wouldn't there be a fear that the customers would leave the bank? So can this actually work in a dual banking system? Are the banks prepared to reduce the customer's return in these kind of circumstances? Would this not lead to a displaced commercial risk? Any one of the panelists would help us clarify that.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. First of all, thank you, Fozia, for raising something which is very pertinent now, especially with the introduction and position of the Islamic Financial Services Act 2013 on 1st of July this year. And this issue comes into play specifically because of the new act. For those of you who are not familiar with the Islamic Financial Services Act, which I will short form as IFSA. In the new law, it has reclassified the deposits which Islamic banks can take. Prior to the IFSA, all the contracts used for deposit taking by the bank are classified as deposits, including Mudarabah, Rabiah, and also other types of deposits. It is classified as deposit, but under the new IFSA, for Mudarabah investment account, it has been reclassified as investment, not as deposit anymore. So that is a very drastic change from the previous position. And under the IFSA, it says clearly that the bank shall guarantee the deposit, but the bank do not guarantee the investment. So effectively, that means for the Mudarabah investment account, there's no guarantee on the part of the bank for the amount kept by the depositor. So in this case, we cannot say depositor anymore, the investor. So whether that would be something that is no longer palatable to the bank or to the customer. From my perspective, I would consider this move as, in a way, something which is illogical, because it is describing the investment in Mudarabah investment account in the true sense. Prior to the reclassification, we have Mudarabah investment account classified as deposit, which is understood as guaranteed, when in reality the contract of Mudarabah itself does not guarantee that the principal will be intact. So by the reclassification, we are making the risk involved in Mudarabah investment account transparent to the consumers. So with that, I think what is necessary for the next step is to educate the customers of the Islamic bank as to the characteristics of these two types of instrument of investment, and the other one is deposit. So by looking at the characteristics and the risk profile, risk return profile of each instrument, we will leave it to the consumer to actually decide whether they want to go more for the guaranteed capital deposit-based instrument, or they want to go to perhaps a higher risk but perhaps better return of a Mudarabah investment account in a very transparent mechanism, because we have segregation of accounts. So it entails a lot of other things, not just the risk classification, but it also entails a segregation of the Mudarabah investment account from the normal deposits. And to some extent, the Mudarabah investment account can be said to be treated as perhaps quite similar to, or have some similar characteristics with the shareholders account, in that sense. So I hope I have addressed some of the issues of your, not all.
Assalamualaikum warahmatullah. Good afternoon. Thank you very much for having me here. I thought that's an excellent question, which requires a deep discussion, because the answer to that question pretty much determines what's the direction of Islamic finance, which our country will take in the future. I think when we talk about displaced commercial risk, this is a term which has been explained and touched upon in many conferences and in many textbooks, but I don't think there has been any deep analysis to define or measure what is the effect of displaced commercial risk, if there is, to the Islamic financial institutions. And firstly, my first point that I would like to make is that there is this notion that there are two camps, two schools of thought, which says that if banks start to really engage in real or equity-based Mudarabah profit sharing investment account, then the customers would run away and they will not have a bank to run. There is also another school of thought that says that the customers are ready for it. So we are somewhat stuck in the middle, and my point of view is, unless we start to define what is the impact of these issues, then it's quite difficult to define which strategy that we should go for. Now, firstly, I'm quite keen to dispel the notion that if banks start to go for a pure or equity-based Mudarabah profit sharing investment account, then the entire banking system will crumble. Why? Because we have seen in our larger Islamic finance economy or system, if you will, banking is not the only component of Islamic finance. There is asset management, there is unit trust, there is private equity, and so on. There is plenty of Islamic asset management and Islamic unit trust out there. And the investors or the holders of this unit trust are exposed to the equity price risk, or to the fluctuation of their investments. And in those cases, they don't necessarily run away. And in fact, in some of the Islamic unit trusts, when the prices actually go down, we observe that some customers or more investors actually buy those shares. So that's my first point, that I don't think there is a direct correlation or logic that if we move to Mudarabah, the entire system will go down. Number two, whenever people talk about displaced commercial risk, people talk about